Hi, in the previous episode, we talked about interest rate risk, what it is and how it impacts financial intermediaries, etc. And then we talk about the example of how interest rate risk impacts the credit, liquidity, and the overall asset liability management of banks, citing Silicon Valley Bank as an example of recent failures. In today's follow-up episode, we'll talk more about the basic risk management tools available to combat interest rate risk from the point of view of financial intermediaries. And we hope that you can perhaps pick up valuable lessons that you can apply in your own financial planning and risk management practice. Interest rate risk management. As a finance professional or a businessman, you might wonder where interest rates are going because it might affect your financial decisions. Should you take a short-term loan and then just roll over the loan for 10 years for your long-term needs? Or should you just borrow for 10 years, one time, big time, as we say over here? That really depends on your interest rate outlook and what your current financial conditions look like and how it reacts to movements in interest rates. Thus, you're clearly subject to interest rate risk. You might therefore want to take a look at how a financial intermediary, in particular a bank, manages interest rate risk and take a page from it. In today's episode, we'll talk about two basic risk management tools: gapping and immunization. Gapping. Gapping or repricing gap analysis measures how rate changes hit a bank's short-term earnings by bucketing rate-sensitive assets, or RSAs, and rate-sensitive liabilities, or RSLs. The first thing to note here is that we're talking about rate-sensitive assets and liabilities, here meaning those that are being repriced in the short term, like during a 1-year period, and will therefore get impacted by changes in interest rates in the period. So a 10-year loan that's repriced every quarter will still be included in the analysis because it's when the asset or liability gets repriced, which is important rather than when it matures per se. On the other hand, another 10-year loan where the interest rate was fixed for the entire lifetime of the loan will not be part of the analysis. The next thing to note is that we compare rate-sensitive assets versus rate-sensitive liabilities. For discussion purposes, we'll talk about the dollar gap. And the dollar gap is defined as RSA, risk-sensitive assets, minus RSLs, risk-sensitive liabilities. If RSA is greater than RSL, then this is a positive gap. If RSA is less than RSL, this is a negative gap. The change in the earnings will be equal to the gap times the change in interest rates, R, which is delta earnings is equal to gap delta R. For example, if the gap is 100 million, then if interest rates move up by 1 percentage point, then delta earnings will be equal to gap times delta R, or 100 million times 1%, or 1 million. If interest rates move down by 1 percentage point, delta earnings is equal to gap times negative delta R, or 100 million times negative 1% is equal to negative 1 million. So an increase of 1% in both RSA and RSLs will increase earnings by 1 million. On the other hand, a decrease of 1% will decrease earnings by 1 million. So clearly, if the gap is positive, increases in interest rates are favorable. If the gap is negative, decreases in interest rates are favorable. Now, what are the management implications? Well, if interest rates are expected to go up, then you can try to be positively gapped so that positive changes in rates would be beneficial, as we saw in the 1 million times 1% example. Now, if interest rates are expected to go down, then try to be negatively gapped so that negative changes in rates would be beneficial. That is, have more rate-sensitive liabilities than rate-sensitive assets. In this case, your gap, if we're negatively gapped by 100 million, then it's going to be negative 100 million times negative 1% equals positive 1 million. So it's going to be favorable to you. Now, if interest rates could go either way and you don't want to be sensitive to interest rate movements, then you can try to have a zero gap. meaning delta earnings is going to be zero gap times delta R is equal to zero. It doesn't matter where interest rates move because it's going to be a wash. It should be noted that being neutral is not the goal per se, therefore. The goal is to take advantage of interest rate movements so that it will be beneficial for the bank should rates move. However, if there is very high uncertainty, then being neutral and keeping the gap as close to zero as possible might be desirable. In all cases, however, there are costs to rebalancing your RSAs versus your RSLs, so it might not be clear what kind of benefit can be had without considering the cost of rebalancing and the impact to the bank's strategy overall in the market. Regardless, as can be seen from here, the dollar gap tells you how rate sensitive you are to movements in interest rates. If you can accurately forecast where interest rates are going, then you can manage your RSAs and RSLs to be positively gap, negatively gap, or zero gap accordingly, based on your call and your market positioning. Now, what are some ways to do this exactly? The key would be to move to or away from rate-sensitive assets or liabilities depending on the gap that is desired. For example, to be more positively gap, add more rate-sensitive assets by issuing more repriceable loans, or you may reduce repriceable liabilities by not rolling them over or moving them to fixed rates maturing further out in the future. However, there are cost implications as well in doing this, and here simulations and scenario analysis would be very useful on top of the basic gap management. Let's move on to immunization. In the gapping discussion, we talk about how changes in interest rates will impact earnings in the short term. We now move to the next stage, taking a look at how changes in interest rates will change the market value of your assets and liabilities on the balance sheet. In particular, we'll discuss classic immunization, the idea being that you might want to rebalance your assets and liabilities such that wherever interest rates go, you're immunized from any harmful movements in those interest rates. For this, we need an important concept called duration, which we already discussed before, but we shall review this very quickly in this episode. Duration is the interest rate sensitivity of an instrument measured in a number that, when applied to a change in interest rates, tells you how much that instrument will change in value. For example, if a bond has a duration of 10, then the change in the price of the bond will be estimated via the following formula. The percentage change in price will be equal to negative D times delta R, where D is the duration. So if the duration is 10 and interest rates move up by 1%, then the bond price is expected to drop by negative 10 times 1% is equal to negative 10%. So if the bond portfolio is worth 100 million, then the new bond portfolio will drop to 90 million should interest rates move up. If, however, yields drop by 1 percentage point, then the price of the bond is expected to rise by negative 10 times negative 1% is equal to 10%. In this case, if the bond portfolio is 100 million, then the new bond portfolio will rise to 110 million should yields drop by 1 percentage point. Finally, we need to talk about convexity, which we also discussed before in the same previous video. The convexity measures the curvature in the price-yield relationship, capturing second-order effects ignored by duration's first-order or linear approximation. And here's the graph. So now we're ready to talk about immunization. The requirements are: the present value of assets should be equal to the present value of liabilities. The duration of assets should be equal to the duration of liabilities. And the convexity of assets should be greater than the convexity of liabilities. For the first requirement, this simply means that all interest rate sensitive assets are equal to interest rate sensitive liabilities in terms of the present value. This is like having a gap of 0 in our gapping discussion above, but this time it's the present values that are the same. Therefore, they simply just offset each other where they are right now and where they can move afterwards, as if they were synchronized in movement. That's the overall approach. The second requirement means that since rate-sensitive assets have the same duration as rate-sensitive liabilities, then wherever interest rates go right now, it doesn't matter because it will impact both assets and liabilities in the same way, offsetting the balance sheet items as far as yield movements are concerned. Now, the third requirement is not quite a strict requirement because in reality, most movements are small enough. The net effect of the first two requirements is that for small movements in rates, the movements in RSAs and RSLs will basically just offset each other. In other words, you're immunized from interest rate risk. But what do you make of the third requirement, that the convexity of assets be greater than the convexity of liabilities? First, we recall the overall percentage change formula we discussed before. The actual percentage change is negative duration times delta x plus the convexity adjustment times delta x squared. Notice that the convexity adjustment is always positive, and it always therefore reduces the drop of a price of a bond when interest rates go up. On the other hand, when interest rates drops, it accelerates the upward movement in prices as interest rates go down. Therefore, having convexity is desirable for your assets, but not really for your liabilities. After all, you want your liabilities to drop much faster when interest rates rise, and to rise much slower when interest rates go down. So you want your convexity to be less for your liabilities versus your assets. This is what it would look like, therefore, exaggerated for effect, but the idea is here. So you have your asset price curve and your liability price curve, and you'll notice that wherever interest rates move from I, you'll have a steeper movement for the liabilities, but a steeper movement up for the assets when rates come down. Therefore, you're better off if the convexity of your assets would be greater than the convexity of your liabilities. Now, given these three conditions, you actually have a gain when interest rates go up or down, for that matter, if your RSAs and RSLs are moving like this. In this sense, if you could find a portfolio of assets and liabilities that move like this, then your portfolio is immunized and you can sleep so much better at night, not worrying about interest rate movements. Now, wouldn't that be great? However, there are key limitations. The first one is that this assumes parallel yield curve shifts. And this fails to capture non-parallel changes like twists or the steepening of the yield curve, leading to inaccurate forecasts in real-world scenarios. It also assumes that assets and liabilities are affected in the same way at the same time. And as we discussed in the previous episode, that doesn't really happen in real life often. Another limitation is that cash flow mismatches are not considered, and therefore it ignores liquidity requirements. And this is especially problematic for the immunization strategies. Another limitation is that rebalancing could be costly or difficult to implement versus just absorbing the cost of interest rates movement, unless derivative instruments are used to mimic the required rebalancing. Last but not the least, does not consider behavioral shifts as a result of market reactions, like there are runoffs, paydowns, debt, embedded options in the underlying bonds, etc. All this can trigger unexpected behavior and unexpected financial implications. Still, these two tools, gapping and immunization, are very useful tools to manage interest rate risk, especially for banks. They are simple to understand and can be the basis for a beginning plan that can be overlaid with complexity for scenario analysis and strategic planning. So, what do you think? Did you learn anything from these episodes? We hope you did, and please feel free to comment below for any suggestions or your comments. In the meantime, that's all that we have for now, and see you next time.